What's up guys? In today's video, we're gonna go over exactly how corporate taxation works. So there's two different kinds. There's active and then there's passive as well. And we're gonna get into both of those in those videos. By the way, this video was inspired by a comment on one of the videos. So if you have an idea for a video, please don't hesitate to comment below. Let me know what you guys are looking for. I love to make these videos. So yeah, the more ideas, the better. But with that, let's get into it. Okay, so just to give a little bit of history. So corporate tax is essentially a taxation on the net income of a corporation. And when I say net income, I'm meaning after expenses, deductions, amortization, depreciation, all of those other things. And I'm not gonna get into it within this video, but it's essentially the net income of the corporation. And these taxes are used to fund a variety of different services, military, economic, infrastructure, healthcare, etc., etc., etc. All of the details of this, by the way, can be found in the Income Tax Act. And I don't know if you're aware of this, but you can actually just look up the Income Tax Act online, and I'll put a link in the comments actually below the Income Tax Act. And if you're really bored, you can actually go and read it yourself. But you should actually read it. I mean, it is something that as a Canadian, you should at least be somewhat familiar with, since we are very heavily taxed, and we do have this system that we should understand. So yeah. All right, so like I mentioned, there's two different kinds. We have active income and we have passive income, okay? So the first one that I'm gonna get into is active income. And there is provincial taxation as well as federal taxation. So there's two different components and then two different types of income. So we're gonna start with active. Now, just to make this easy, I'm going to be giving you examples of actual tax rates, and now it is 2021 right now, and I'm in Alberta. All of these can be found. Again, I'll post a link to a website where you can look up different tax rates very quickly. It's taxtips.ca, but I'll put it in the comments, no worries. But you're gonna add essentially the provincial as well as the federal tax rate to get your overall combined tax rate. Okay, so within active business income, and what do I mean by active business income? Well, let's say that you're a hair salon. Well, of course, you know, receiving a commission or receiving income from people that come into the hair salon, that's gonna be active business income. If you're a hair salon and you have an investment portfolio, well, that's not active business income. Active business income is the actual business, the active business that you're in. So electrical companies doing electrical work, a construction company doing construction work, etc., etc. It's the active business income. Now, in Canada, we have access to two different tax rates for this active business income, as long as you are what's known as a Canadian-controlled private corporation or a CCPC, okay? And real quick, to be a CCPC, you need to be incorporated in Canada, and essentially you also need to have a resident in Canada control the corporation. There are some few other details, and I'm not gonna get into it in this video because it can be a little bit complicated, but those are two reasons right there. So if you're a Canadian citizen and you live in Canada and you incorporated your business, chances are you're a CCPC, okay? So the two different tax rates that are available on active business income, the first one is what's known as the small business deduction. And this is available from $0,000 or $0 all the way up to $500,000, okay? And right now in Alberta, the current tax rate for this is 11%. So it's 9% federally and then 2% provincially. So depending on what province you're in, it might be a little bit different, but it's that lower rate now at 11%. And like I mentioned, this is available up to $500,000 everywhere in Canada except Saskatchewan. They get $600,000 because, well, I don't know, they get it. Who knows, okay? Now, after $500,000, we go to what's known as the general tax rate, okay? Now, the general tax rate is going to be a little bit more. So in Alberta right now, our general tax rate for the federal is 15%, and for the provincial, it's 8%. So add those together, you get 23%. And now this is on income after $500,000 net income within a corporation, okay? So before $500,000, you get that small business deduction. In Alberta, it's 11%. After that $500,000, you go to the general rate, which is now 23%. Now, I know what you're thinking, wow, that kind of sucks. Maybe I should just always make under $500,000 and then I never have to pay that because you're gonna pay the taxes and never get it back. Well, that's not true, okay? So when you pay out dividends from your corporation, you can pay out non-eligible dividends and eligible dividends. And I'm not gonna get into it in this video because I made a video on that already and you can find it right there. But essentially, when you pay out an eligible dividend, which comes from income over $500,000 on that general rate, you're gonna receive a higher tax credit and pay less taxes when you take it out personally. because the CRA doesn't want to tax you twice. They don't want to have you overpay in taxes. They want to equalize it exactly the same had you been just an employee and earned that as a salary. Now, investment income in a corporation gets a little bit more complicated because there's a lot of different mechanics. There's different type of investments. There's some corporations that have investment income that could be considered active income. So it's not quite as clear cut as active income, but I'm gonna try and explain a little bit of it in this video. And if you guys want me to do a deeper dive, just let me know in the comments below that you want more information on this, but I'm gonna try and give you an overview of how investment income or passive income works within a corporation, okay? So just like the previous example, we still have our federal and our provincial rate as well. So the federal rate the federal rate all over Canada, pardon me, is 38.7%. And in Alberta, the provincial rate is 8%, okay? So you combine those together, you get 46.7% on investment income. And I know what you're thinking, wow, that is a lot of taxes. I'm gonna explain how it works fundamentally in a corporation so you get a better idea of why they're charging such a high tax rate on passive income, or passive investments, I should say, and you can understand a little bit more of this better. So passive income can come from a variety of different sources. It could come from rental properties if you're not an active rental or a real estate business, pardon me. It could be interest, it could be a dividend, it could be a capital gain, and all of these kind of have some special features around them, and I'll explain them here. Passive income, such as real estate income if you're not an active business, or let's say interest income, that's taxed at 100% of that tax rate. So like I mentioned, it's 46.7% in Alberta. Different provinces have different provincial rates. I just wanted to give you some numbers here. Real estate or interest, things like that, passive income, that's gonna be at 100% of that tax rate, okay? Capital gains now, on the other hand, are taxed at 50%. So when a corporation disposes of some type of property, eligible capital, such as, let's say, a stock or real estate, or just to make it easy, let's just make it a share of Apple stock or something like that, okay? 50% of that is going to be the capital gain. 50% of that is going to be taxable at that passive rate, so 46.7%. The other 50%, however, is going to be allocated to something known as the CDA, which stands for the Capital Dividend Account. And all this is a notional account that keeps track of what's known as capital dividends that can be paid out to shareholders. And this can actually be paid tax-free. So half of that capital gain can be paid out to the shareholder tax-free, which is really advantageous as an investment, okay? Now, the third type is, of course, dividends. And dividends get a little bit complicated because let's say that you own that same share in Apple stock, and instead of disposing of it and having a capital gain, let's say that they just paid you a dividend. Well, a dividend has a special tax rate within a corporation of 38 1/3%. Now, the reason that it's lower is because a dividend is paid from after-tax profits from a corporation, from another corporation. And the rules regarding connected corporations and all that get a little bit complicated, so I don't want to get too much into it in this video. But the reason that tax rate is lower is because, again, the CRA knows that wherever that dividend came from, they already paid some taxes on that income. And so when they pay it to the shareholder, being the corporation, okay, well, they know that already some taxes have been paid, so we're not going to tax them the full amount had there been no taxation paid on that yet. Okay, the last thing that I want to touch on very briefly here, because it's a very complicated idea or area of tax, I should say. I could make an entire video on this, but I won't be, well, I will actually. If you guys want a video on RDTOH, drop it in the comments below. I'm happy to make a video on this stuff. I love talking about this stuff. So you're probably wondering, why is the tax rate on passive investments in a corporation so high? Why is my active income at 11%, yet if I have any type of investment in my corporation, I have to pay like 50%. Like, that makes no sense. And I'll explain the reasoning behind this. And I'm not gonna get into the numbers because it will get a little bit complicated depending on if it's a dividend or if it's interest or if it's capital gain. So I don't wanna get too much into that. And I'll explain the mechanics behind this just so you understand it. And again, if you want me to actually get into the nitty gritty, drop it in the comments below. I'm happy to make a video on this. So there's a system known as integration, and all that means is the CRA is trying to make it fair for an individual who has a job and he works at a company and he receives a salary, and they want to make that the same as another individual who owns a business and he has income within his business, okay? So the way that they do this is through something known as refundable dividend tax on hand. And all this means is that we have this high taxation on passive investments. I'm 46.7 here in Alberta, but it can go as high as 53%, 54% in other provinces. So they tax those investments very high at the beginning. However, refundable dividend tax on hand essentially means when you pay out a shareholder a dividend and you have a balance in this RDTOH account, they will refund some of the taxes that you previously paid on those investments. So every time you pay taxes on passive investments within a corporation, you're essentially creating room in this notional account. You're creating a positive balance in this notional RDTOH account within the corporation. And all that is a little earmark for the CRA to know, oh, he's paying a whole bunch of taxes in the corporation on these passive investments, no problem. When you pay it out as a dividend to the shareholder, they know now all of a sudden, well, we're gonna get some of those taxes back because he's gonna be paying whatever his marginal tax rate is on that dividend. So we're gonna refund some of the taxes to the corporation and they can have that money back that they already paid in taxes. Now you're probably wondering, this sounds so complicated. Why would the CRA, why would the Department of Finance come up with such a complicated system? It doesn't make any sense, okay? The primary reason behind the entire high passive tax rate and the RDTOH is they want to make it equal for an individual with a job and an individual who owns a corporation, okay? So because we have this low tax rate on active income, like I mentioned, 11% here in Alberta, because we have that low tax rate, if we have an individual that makes, let's say, $500,000 in income within a corporation, well, he's got $444,000 or roughly $446,000. Is that right? Let's see here, 500 would be 11%, carry the 1, 55, $445,000 left in the corporation that he could invest it into his business, but he could also put it into an investment, right? So now he has way more upfront capital to invest into some type of investment, stock, bond, mutual fund, real estate, whatever be it, okay? And he can continue to do this year over year over year, so you can see how this compounding effect over 10, 20, 30 years would give that shareholder an unfair advantage over, let's say, a salaried employee who makes $500,000 a year. Well, that individual is going to be paying a hefty amount of tax, and he's probably going to be left with $280,000, maybe $300,000, depending on what province he's in, to then reinvest back into investment. So they want to level the playing field. So what they do with that is say, no problem, you can invest it into a passive investment, but we're going to have a high tax rate up front. And then whenever you pay that out to yourself as a shareholder via a dividend, right, now we understand that we are gonna really see what your marginal tax rate is, and you're gonna pay taxes on that personally, and then we're gonna refund that back to the corporation. So I didn't wanna give any numbers because it can get quite complicated, but that's kind of in essence the theory of integration. If you guys enjoy this stuff, I have a ton of free resources that can be found in the description of every video, both for business owners and financial advisors. And if you guys are enjoying this content, it would mean the world if you just give me a thumbs up, and I'll see you guys in the next one.